We are live from Bloomberg's world headquarters in Midtown Manhattan. I'm Matt Miller. We are streaming as well on Twitter and on Facebook.
And I'm Kaylee Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, from Wall Street to Silicon Valley, we'll discuss the growing institutional interest in crypto with Meltem Demirors of CoinShares.
And Bitcoin breakout. Bulls are predicting more gains ahead as the biggest digital asset wipes away this year's losses. We're charting crypto with Katie Stockton of Fairlead Strategies.
And change the code, not the climate. Greenpeace and a billionaire lobby the Bitcoin community to alter the way it verifies transactions.
All of that is ahead, but first let's get a snapshot of what some of the tokens are doing. Your best way to see that on the Bloomberg terminal, CRYP Go. That is your function, but I have a little look here at some of the big movers. Bitcoin is a little softer over the last 24 hours. Still, though, it is above the $47,000 level. We have seen a breakout from the range. It really has been in all year. The question is, where does it go next? And what's interesting is Bitcoin is still underperforming recently relative to Ether. Really a lot of optimism building about that upgrade to the Ethereum blockchain. The merge that will be coming later on this year. It's trading around 3,400 or so. And Ethereum Classic, also seen as a beneficiary of that, may drive some miners toward it. It's up 1% today, around 49. An underperformer, though, Ripple. XRP down 4 percentage points, even more so on the day. We're trading just under 86 cents, Matt.
All right. I have always thought about what would happen if you put just some of your money in Bitcoin back in the day, back when I had hair and a mustache. If you'd only dedicated 1% of your portfolio in 2014 to Bitcoin, right now your portfolio would be doing 50% better than without. Institutions and investors are placing their bets now on the future of digital assets.
In the world, there are no investors in Bitcoin because it's not an investment. It is an asset. No one thinks it's an investment. It's a casino chip.
The ones that are still sitting out from this market, frankly, they're just going to be left behind.
I believe this is the most important technology we will see in our lifetimes.
Institutions aren't viewing these major cryptocurrency assets as replacements, more so as something that goes alongside.
Bitcoin has had an amazing boom and it continues to do something amazing. I'm personally really in love with Ethereum.
What's really encouraging to see from our seat is really some of the traditional players beginning to get into crypto trading.
All right, this month we're seeing more evidence that big banks and financial firms are warming up to crypto. No one knows better than Sonali Basak, the latest on increasing institutional investor interest.
A lot of signs, Matt, of institutional interest. We have Goldman Sachs in recent days announcing its first over-the-counter crypto options trade. That expands the booming market for crypto derivatives. But to go one step further, you have boutique bank Cowen, which took a bigger step, offering not one, not two, but 16 coins in the spot trading market, from Bitcoin to Ether, Solana, and Uniswap. Firms such as Bank of America have set up crypto research arms, and others like JP Morgan are making tentative steps in crypto futures trading. It's not just big institutions and banks. Let's look at the venture capital that has flocked to this space. Venture capitalists poured more than $32 billion into digital asset startups last year. That's more than in all previous years combined, according to data by PitchBook, and investments keep flowing in. If you look at this year alone, VC firms pumped another $9 billion into the sector this year. So that is in 1/4 of the year, 1/3 of the money that you saw last year, guys.
All right, Sonali, thanks very much. Sonali Basak there talking to us about institutional interest. Meltem Demirors is the Chief Strategy Officer at CoinShares. She joins us now from our studios in London. And Meltem, I think you have actually one of the most elegant products to enable institutional holding of Bitcoin in your ETPs. Are you seeing a lot of interest in that?
We are. So we track weekly fund flows in a report that we publish every Monday morning. And we have seen some inflows and outflows over the course of the last 6 months or so when Bitcoin hit its previous high in November. But this year we are up 200 million in inflows. We saw over 6 billion in cumulative inflows into crypto structured products that are publicly listed and traded last year. We continue to see a lot of interest in Bitcoin products, but also obviously Ethereum is popular, as well as new and emerging protocols like Solana and others that enable smart contracts and other types of blockchain computation. So we continue to see enthusiasm, but the U.S. needs to get its act together. We need a structured product in the U.S., a true ETP.
Right, yours is a Canadian product, but I think it solves the custody problem for a lot of institutional investors, right? What is the cost of holding that ETP?
Yeah, so we have 3 different platforms at CoinShares. Our Canadian platform is managed in collaboration with 3iQ. That has a very low fee, under 1%. A lot of the fees on the US products are quite high, closer to 2.5% per year. We also have an ETC, or an exchange traded commodity, that is listed throughout Europe in multiple markets across Switzerland and other countries, and that has a very low fee of 95 basis points. Again, what we're starting to see is fee compression as more providers offer products, and again, what we're really excited about is the opportunity to see products like this in the United States that will actually track the price of the underlying, as opposed to trading at a discount or premium like so many of the products that we see in the U.S. market today.
Well, and Meltem, as you said, the U.S. needs to get its act together, quote unquote. On the regulatory front, some of the uncertainty, lack of clarity around it, how much do you think that has held back larger institutions from getting into this space?
That's a great question. Frankly, I think now there's so many different channels through which institutions can access the asset class. We have exchange-traded products that are traded in other jurisdictions, and we do see investors trading those products in other jurisdictions. We also have over-the-counter trading. We have the cash-based products, the cash settlement products the CME offers, which also offer exposure much easier for investors to trade because they don't have to necessarily touch crypto directly. And I think over the next year or two, we'll continue to see more institutions engaging directly as opposed to going through a structured product. But again, the holy grail here in the US is the retirement market. There's $34 trillion of retirement assets today that are really challenged to access crypto. And again, with the chart you showed, Matt, a 1% allocation to Bitcoin is a great portfolio diversifier. It's a great asymmetric risk-reward bet. So we want to see more US investors have the ability to add Bitcoin products that provide true Bitcoin exposure to their retirement accounts if they so wish. And hopefully we'll start to see that become easier for investors in the coming months and years.
What about stablecoins, Meltem? How do they factor in here?
Yeah, absolutely. So stablecoins have been a really exciting innovation in the market. Again, we have to remember back in 2013 when our trading desks first started trading Bitcoin, it's very difficult to settle cash against Bitcoin. Bitcoin settles with finality within several blocks, right? And a block takes about 10 minutes on average, and you average wait 6 confirmations. But cash can take 2 to 3 days to settle. So stablecoins make crypto compatible with the banking system by putting dollars on chain and allowing them to settle with finality against Bitcoin and other crypto assets. Today's stablecoins are about 10% of the overall crypto market. So with about a $2 trillion market cap, that equates to about $200 billion of stablecoins in circulation. They continue to grow in popularity and usage. And again, we see institutions experimenting with issuing their own stablecoin. Notably, JP Morgan was the first to do so. They're using it internally to reconcile trades and settle trades internally. But we could very well see banks operating stablecoins and using stablecoins to settle trades within their own institutions or even in between institutions in overnight rates and other products that require rapid settlement.
One of the great institutional hopes for crypto was Ripple. They've obviously had some serious regulatory and legal issues, and viewers have been incredibly vocal about wanting to know more about XRP versus the SEC. What's your take on Ripple?
Look, I don't have necessarily a take on Ripple as a technology. What I will say is a lot of investors are interested in Ripple. We do have a Ripple ETP in the market. Again, we as an asset manager, we provide the products our clients ask for, and some of them are really interested in XRP. I personally don't have it in my portfolio. I am very excited about Ethereum, about Solana, about other layer 1 blockchains that are decentralized, permissionless, and being widely utilized by open source developers and by the broader crypto ecosystem. So sadly, I don't have an opinion on Ripple for your viewers.
What about, Meltem, so many people are saying that we need the Treasury and the Fed to work on a CBDC to be more competitive. And Kaylee already talked a little bit about Tether or dollar-based cryptos. Do we need to have something central bank based? Does it have to be coming from the U.S. government in order to make us competitive with the Chinese and others?
My view on stablecoins is I think they play a very useful role in terms of providing dollar liquidity in the crypto ecosystem, making crypto compatible with the more traditional banking system. My view on stablecoins that are issued as central bank digital currencies is a little bit more nuanced. I think consumer privacy is a really important consideration, and consumer privacy and the right to financial privacy and the right to transact freely has been under question since events that have unfolded in Canada, which is currently happening with the conflict in Russia and Ukraine. Exactly. So I think as we think about CBDCs, we really need to balance the societal impact of a loss of privacy and a loss of financial sovereignty, which has been the backbone of America since its earliest founding days. So I think that balance is very important to maintain. And I think as we deliberate the future of central bank digital currencies, it's important to think about the potential risks that they could pose to the integrity of the financial system, particularly to individuals.
How do you see CBDCs coexisting with existing coins that are out there, though, Meltem? I mean, does one displace the other?
Absolutely not. Nobody is going to buy a CBDC to get exposure to the crypto sector. The value proposition here is fundamentally different. I think CBDCs or stablecoins generally, people aren't holding stablecoins because they want exposure to the dollar or the pound or the euro. The reason they're holding stablecoins is to take their portfolio and put it in something with relatively stable value, hence the name stablecoin. And it's also often used as a settlement pair. So I think the advent of more stablecoins coming from different issuers, whether those be banks, institutions, crypto native institutions, or sovereign governments, it will all sort of functionally serve the same purpose. I think what's really exciting is these currencies need to be compatible with the blockchains on which assets are trading. It's our view at CoinShares that all markets will eventually trade on-chain 24/7, 365, and settle with finality in whatever trade pair you're trading. So from a market structure perspective, I think it's much easier to build things when you have stablecoins that all operate on the same rails as all the other assets we're trading. So from a market structure perspective, I think stablecoins are incredibly important, not only to crypto, but to other assets that I think will inevitably be traded on this global financial interoperable infrastructure that we've never really had before.
Meltem, great to get some time with you. Thanks so much for joining us out of London. Hope we can get you in the New York studio soon. Meltem Demirors there of CoinShares. Now, coming up, we're going to chart crypto, dive into the technical analysis of Bitcoin and Ether with Katie Stockton of Fairlead Strategies.
Plus, making mining more sustainable. We'll speak with Samir Tabar of Bitcoin mining company Bit Digital.
And to access all the latest data and news on crypto, check out CRYP Go on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Crypto. I'm Kaylee Lyons alongside Matt Miller at Bloomberg's global headquarters in New York. Well, investors are speculating that Bitcoin's break above the $50,000 mark could be coming soon as it erases all of its year-to-date losses. Katie Stockton, founder and managing partner of Fairlead Strategies, is joining us now for a technical perspective. So, Katie, we know Bitcoin has been in a range for the entirety of this year so far. It seems we have broken out of it. Where's the support? Where's the resistance? What do you think is coming next?
Well, there's certainly a short-term breakout, and that comes after what was an oversold condition from an intermediate-term perspective. It's always very important that we see a reaction like this to those intermediate-term oversold readings, or it suggests that we're in a bear market. So indeed, our indicators are now pointing higher. So Bitcoin and also Ether, they narrowly avoided big breakdowns earlier this year. They came into support that we define using the cloud model, which has a Japanese name, Ichimoku. It is something that we can see on the Bloomberg charts there. And it's about 38,000 for Bitcoin that was tested successfully and served as a staging ground for this nice relief rally. And because that level was left intact, it basically kind of preserves this long-term range. And we have what is a short-term bullish bias just with the breakout that's occurred. In terms of momentum and in terms of resistance, the positive momentum is already leading to a test for Bitcoin, at least of the 200-day moving average. The 200-day, mind you, has kind of flattened out a little bit, somewhat equivalent to the 40-week moving average that we have on our chart. And that does reflect a loss of long-term upside momentum, but it's also a bit of a psychological hurdle. So when we do see cryptocurrencies and any other asset clear the 200-day, it tends to be a nice sort of boost to the momentum that is already there. So if we see a little breakout above the 200-day, that would be a good thing.
What do you think about Ether? Do you also use Ichimoku to look at Ether?
I do, yeah. We use the same methodology for just about every investment vehicle there is. So it's not specific to the cryptocurrencies, but it's definitely applicable, especially to commodities and FX. Anything that trades with liquidity globally really seems to adhere to these cloud-based levels. So we're also applying it to Ether. Support around 2350 was tested and held successfully. And again, here now, we're seeing these minor breakouts to the upside above the equivalent cloud-based resistance on the daily chart. So we do have these minor breakouts, and we are seeing nice upside follow through. That's of course shared by the equity market, to which the cryptocurrencies have been positively correlated this year. Bitcoin, I think, has room to test resistance around 51,000. It's been a level that's been a focus of ours for some time now, and it's based primarily on a 50% retracement level. And that was a natural objective for what we've seen so far.
All right, Katie, thanks so much for joining us. Katie Stockton there from Fairlead Strategies. By the way, you can see the Ichimoku analysis on the Bloomberg by typing IGOC or GOC Go. Coming up, making mining more sustainable. We'll speak with Samir Tabar of Bitcoin mining company Bit Digital. This is Bloomberg.
This is Bloomberg Crypto. I'm Kaylee Lyons with Matt Miller in New York. Well, climate groups, including Greenpeace and Ripple co-founder Chris Larsen, have launched a Change the Code, Not the Climate campaign to pressure the Bitcoin community to alter the network's code to make it less power hungry. Campaign director Michael Brune saying, quote, "We are hoping, particularly since Bitcoin is now being financed by entities and individuals who care about climate change, that we can compel leadership to agree that this is a problem that needs to be addressed." Joining us now is Samir Tabar, Chief Strategy Officer for Bit Digital, a NASDAQ-traded Bitcoin mining company that has a distinct focus on sustainability. So, Samir, it is great to talk to you about this. Can crypto mining be truly sustainable? How can it be so?
It can be, absolutely. In our case, we're about 70% carbon-free, and we do that with various methods. We use solar, we use hydro. In fact, we have 2 partner facilities in upstate New York that draws power from the Niagara River. And so we use those sources of power that's carbon-free, not carbon neutral, which is a very big distinction to make. And according to our latest filings, we're about 70%, and we intend to be 100% in the medium-term future.
How does that compare to the rest of the industry, Samir?
The data points on the industry is not particularly clear, but what I can tell you that Bitcoin mining as a sector uses more renewables than most other industries. If you compare, for example, the existing financial system, the carbon footprint is much less in Bitcoin mining compared to the financial system. And if you think about all the banks and the ATMs and so on, lots of these buildings and the facilities that are used to power the existing financial system is not run on renewables. So it's a little bit funny that there's so much focus on Bitcoin mining. And I have a pretty good theory as to why.
Okay, give it to us.
Well, frankly, I think that this is a threatening technology to the existing financial system. The coin credit system and the paper system that the existing financial legacy institutions, they rely on these inefficiencies in that system. Those inefficiencies is what makes their money. And Bitcoin mining solves those inefficiencies. And so they're threatened by that. So they're using these fake environmental arguments against Bitcoin mining because they're trying to take it down.
All right, Samir, let's talk about what's going on here in New York State. The Assembly's Environmental Conservation Committee voted last Tuesday to advance legislation that essentially would impose a 2-year moratorium on an energy-intensive type of cryptocurrency mining. I'm wondering what your take is on that legislation and whether or not those kind of guardrails are appropriate.
Look, the New York State policymakers have made the right move, not pursuing a scorched earth, one-size-fits-all moratorium approach as it relates to digital mining. So that's a good thing. And New York, is now well poised to maintain its role as a global hub of finance and innovation by opening the doors to forward-thinking policies. There are good actors and bad actors in the Bitcoin mining sector. We think we're in the category of good actors, those who actually make an effort using renewables. And so it's good for policymakers and the good actors in the sector to work together and figure out what's the best approach before just banning an entire sector and it going, for example, to Texas, which is in some degrees happening right now.
So what is the best approach that you would recommend, Samir?
Well, I would recommend a study bill. We should study it a little bit more. There seems to be a bit now to enact any legislation against Bitcoin mining. There should be a bit of a study bill and a pause just to have a more thoughtful approach to it. But if there's going to be legislation, there needs to be a distinction between good actors and bad actors. And those who use sustainable sources of power or have that in their mandate and are working towards that should not be affected by any legislation.
Samir, I want to finally ask you about nuclear. I just moved back from Germany, where they wouldn't consider nuclear power at all green, but of course, our neighbors, like those in France, do consider it green. And I think the EU is actually changing the rules to make nuclear power green power. What if Bitcoin were mined with nuclear? Would you feel okay with that?
I mean, there is definitely some noise about miners tapping that source of power. We're not looking at that. And I know there's a lot of debate and controversy as to where that would fit, whether that's green or not. I personally believe that nuclear is positive, but of course there need to be guardrails. There can't be any risks of, for example, what happened in Japan and to its nuclear plant when that natural disaster struck. Yeah.
All right, we have to leave it there, but thank you so much for joining us. Really appreciate your time. Samir Tabar, Bit Digital, thank you so much. And of course, Matt, we'll be back here same time, same place next week, Tuesday, 1 p.m. Eastern time. Coming up on the show next week, we'll be talking to Harvard economics professor and crypto skeptic Ken Rogoff. Plus, Michelle Bond, the CEO of the Association for Digital Asset Markets, will be joining us as well. From Bloomberg's world headquarters in New York, this is Bloomberg.